Hi, I'm Nick Schultz at the American Enterprise Institute. My guest today is Peter Wallison, my colleague at AEI. Peter, thanks for joining me.
Pleasure to be here.
Peter is a resident fellow here at AEI where he works on financial services issues, and a senior fellow where he works on financial services issues. And but for the purposes of this conversation, I want to talk to you about your recent work on the Financial Crisis Inquiry Commission, the FCIC, and in particular a dissent that you released, Dissent from the Majority report that was put out by the Commission. First of all, just tell me what you felt the Commission's purpose was when you were picked to be on it, and what you thought from the beginning its purpose was, and whether or not it lived up to that.
The purpose of the Commission, it seemed obvious to me, was to find the causes of this awful financial crisis that we had in 2008. There couldn't be any other good reason for establishing a commission except to enable public policy people and lawmakers to avoid the next crisis by understanding what caused this one. So from the very beginning, my assumption was that what we had to find were the causes of the financial crisis. And
your sense is that the Majority report, which came out earlier this year, did not do that?
It was far from it. To the extent that they described any kind of reasons for the financial crisis, they left out the most important causes when they discussed those reasons. Most of their reasons had to do with the things that I guess people on the left, the Democrats, would like to have been the reasons, and that is insufficient regulation, insufficient smart activity on the part of bankers and others. And that's all they looked at, and that's what they concluded. And so in a sense, it served as a justification for the Dodd-Frank Act, which passed last July.
Well, although the Dodd-Frank Act passed even before the Commission was able to finish its work.
Exactly. Well, it was based on the same attitudes. That is to say, Congress thought, not all in Congress, the Democrats in Congress, the Republicans all voted against it, but the Congress thought that the reasons for the financial crisis were insufficient regulation and insufficient risk management by the managers of most of the large financial institutions around the world. Okay,
now I want to get to Dodd-Frank in just a little bit, but I want to talk to you about the reason for issuing your dissent, which is that you believe that you have found, have put your finger on that without which this crisis could not have occurred. Tell us what that is and how you came to this conclusion.
Well, I think everyone agrees. I don't think there is any dissent from this point, and that is that what ultimately caused the financial crisis was the failure, the delinquency and default of a huge number of subprime and other very risky mortgages that were in our financial system in 2008. Just after the huge housing bubble that we had deflated, those mortgages began to default in enormous numbers. Everyone agrees that that weakened the financial institutions that were holding those mortgages all around the world, and that was the cause of the financial crisis. The thing that the Commission never investigated, never even attempted to investigate, is why there were so many subprime and other risky mortgages in the financial system. What it implied, of course, is that there was a huge breakdown in the underwriting standards that had traditionally been used in the United States, because in past years, or in past bubbles, I'll say, one of which occurred in 1979, another in 1989, they were very small. When they deflated, there were local losses. People lost money in local areas in this country, but we never had a financial crisis like this where we lost 30% of the value of all homes, and we never had a bubble that lasted for a housing bubble that lasted for 10 years. So the thing that we should have focused on is why all of these very weak mortgages were established in our financial system.
Well, and not just why, and we're going to get to that in just a minute, but also how many and the extent of it. And a big part of your dissent, and to me some of the most compelling stuff in it, is is your work and also the work of Ed Pinto, another AEI fellow, who there was a lot of detective work that had to go on, which is to figure out how many of these faulty mortgages were out there, and who was holding them and why. And talk to me, there's this big number that jumps out, yes. 27 million. Talk to me about what I now in my mind call the number. How many of these mortgages there were, how much that constituted as a share of the entire pool of mortgages outstanding in the country, and the extent to which this was unprecedented in certainly American mortgage finance.
That's right. The total number of these subprime and other high-risk mortgages, we call them Alt-A mortgages, and occasionally I'll use the word Alt-A, but otherwise, to avoid that technicality, I call them high-risk. But a subprime mortgage is a mortgage made to a person who has blemished credit, who doesn't have a history of meeting his or her financial obligations. An Alt-A mortgage or another high-risk mortgage would be one to a person who doesn't have a down payment, or doesn't have a sufficient down payment, or is a mortgage that is paying only interest, does not amortize principal. Things like that are what constitute Alt-A or other high-risk mortgages. Now, there were 27 million of those subprime and other high-risk mortgages in our financial system at the end of the bubble period, which ended in 2007, and the financial crisis occurred in 2008. Of that 27 million, which turns out to be half of all mortgages in the United States, there are about 55 million mortgages in the United States. 27 million is about half of them. Of that 27 million, 19 million can be traced directly to the policies of the U.S. government.
Okay, and just before we get that, I want to get to that in a second. Prior to the bubble, the run-up in housing prices from the late 1990s through 2007, 2008, what percent, you found in 2008 half of the mortgages were non-traditional mortgages or,
That's right.
mortgages of questionable quality. What would the normal rate be in American history of those kinds of mortgages as a percentage of the whole? It wouldn't be 50%, right?
These things have not been kept track of very well over time, and we didn't even have many good standards for what a subprime mortgage was. But I guess most people would say that subprime mortgages never got beyond 10%. That business, the subprime business, was always a niche business. There were a few lenders in that area, and they made a living making loans to people who were high risk, but it was always a very small proportion of all mortgages. Here we're talking about 50% made up of not only subprime, but mortgages that are in some cases worse than subprime because they have no down payments and they have no documentation and they don't amortize principal in any way. They're very, very weak mortgages.
So, and the only way for this number and the extent of these mortgages to take off in the way that they did was for traditional lending standards to erode over time, which is
That's
what
right.
happened and what you document in your dissent.
Right.
Talk about that. How did that happen?
Well, this is really the key point, it seems to me, and the reason for the dissent. And that is that the Commission really refused to look into why this decline in underwriting standards actually occurred.
And no one denies that it occurred,
no,
right?
No
Anybody who
one
knows anything about mortgage finance or knows that this was something that happened,
Never
right?
had happened before.
Right.
Up until 1992, there were very few times when we had any significant numbers of these bad mortgages in the financial system. So my quest was to try to understand why we had so many subprime mortgages, because subprime and other high-risk mortgages, because it seemed to me that when the bubble deflated, that in itself would not cause a financial crisis. It was only what was in the bubble that was important. And when the bubble began to deflate, all of these very weak mortgages became susceptible to deterioration, to failure, to default, to delinquency, and that is what we saw, and that is what caused financial institutions to look so very weak. Now, why did underwriting standards decline when for 100 years before then they never had? And it seemed to me that it's very clear what the source of that was, and that is government housing policy was so administered that it was in many ways turned into a social policy, in that the idea was to make mortgage credit more easily available to people who had never been able to qualify before for housing mortgages because they didn't have the income and they didn't have the good credit rating and they didn't have down payments and things like that. How did that occur? It occurred originally through affordable housing requirements that were imposed on Fannie and Freddie. Now, what is an affordable housing requirement? An affordable housing requirement is literally a requirement that when Fannie Mae and Freddie Mac buy loans, a certain proportion of those loans has to be made to people who are at or below the median income in the areas where they live. And initially, in 1992, that number was 30%. So whenever Fannie and Freddie bought a loan from a bank or from another originator, that loan had to go into a category. If it was to be an affordable housing loan, it had to be made to a person who was at or below the median income in that area, and it had to be among a number of loans that was at least 30% of all the loans that they bought. That standard increased over time. In 1995, that standard was made 42%. In 2000, it was made 50%. And then into the Bush era, it was increased even further, so that by 2005, the standard was 56%. Now, what that means, of course, is that every time Fannie and Freddie buys a prime loan, they have to buy one and a little bit more of a loan that qualifies as a affordable housing loan to a person who was at or below the median income. Well, what would that mean? It meant that you have to find a huge number of loans in the lower half of the income range in the United States. And not only that, when you were doing that, you had to compete with a whole lot of other institutions that were doing the same thing, because the Federal Housing Administration had exactly the same mandate. They had to make loans to people at or below the median income. The banks, under something called the Community Reinvestment Act, had to do the same thing. And then finally, the subprime lenders signed on to a HUD program that required them to reduce underwriting standards so that they made loans, again, to the same people preferentially. Well, when all of these institutions have government backing in one way or another, and are all seeking loans from the same part of the population, which is not at a particularly high income, in fact, it's a low income portion of the population, what happens? Many of the loans that were made had to be very weak and risky loans. They had to be made to people who could not support a prime loan. They were only able to support a subprime loan or another kind of loan that didn't have a down payment or didn't otherwise have many of the things that you would expect a prime loan to have. That's what drove underwriting standards down.
And there's lots of documentation in your dissent where you point out that officials at Fannie and Freddie who were involved in this admitted freely that what we were doing is lowering our standards in order to comply with these requirements. Is that right?
Yes, there's plenty of documentation for this. You can see it all the way through Fannie's documents, starting in the early 1990s and running right up until 2007. The Commission, unfortunately, simply ignored these documents. They instead used testimony from people at Fannie and so forth to try to make a case that Fannie and Freddie did not buy these subprime or other weak loans in order to comply with the affordable housing requirements. They tried to make the case that they bought these loans to make profits. This is a very tough case, since Fannie and Freddie in 2008 became insolvent. And if you've actually been buying loans because you thought they would be profitable, it's very unlikely that you will become insolvent by buying profitable loans. In fact, they're not just insolvent to a small degree, they're hugely insolvent. And their regulator recently estimated that the taxpayers in the United States are going to have to pony up the money to pay for what's already baked in the cake in Fannie and Freddie, something from $221 billion to $363 billion. So this was another financial catastrophe, just like the S&Ls in the late 1980s, where the taxpayers, because of the government's bad policies, are going to have to come up with a good deal of money to bail out another government program.
I want to ask you about a quote in the dissent where you mentioned that Ed Pinto had looked into this, had been gathering a lot of the data showing just how many of these mortgages were out there. And you write, quote, Pinto's research was never made available to the other members of the FCIC or even the commissioners who were members of the subcommittee charged with considering the role of housing policy in the financial crisis. How is this possible? This seems to me like something that would be of obvious interest and that would be is clearly relevant, given, as you pointed out, nobody denies that the subprime and all-day collapse was a trigger event for this financial crisis. So how is it possible that they didn't consider this?
Well, of course, this is one of the reasons why I started writing my dissent, because it was plain to me that we were not going through an objective investigation of any kind. This was an effort to prove a certain case on the Commission's part, and that is that there wasn't sufficient regulation and there was bad management among large financial institutions and so forth. Whereas it seemed to me that at the very least they ought to investigate other alternatives. That's why I complained about the fact that when they had all this data from Pinto, they didn't even use it for any purpose. If I had been running this, and if I didn't agree with Pinto, still, since it was a government program of some kind, government was paying for it, the American people are entitled to an answer, I still would have had Pinto come in, I would have put him in front of the commissioners, under oath, given the commissioners his paper, and let them ask him questions as long as they wanted to satisfy themselves that he was wrong. But they never even did that. So it was not, in my view, an objective study of any kind. And so soon after we started, which was in December of 2009, I began to accumulate outside the Commission data that would at least allow me to determine whether there was any other cause of the financial crisis other than what it was obvious the Commission was going to be deciding.
Yeah, and I should say it's plain from the dissent that it's more than a dissent. What it does is outline an explanation for what actually happened in a way that I at least think that the Commission in its majority report failed to do. I want to talk to you about a couple of counter narratives that are out there and have you address those. One is that there's obviously a lot of talk, and the Commission takes up the role that structured finance may have played in the financial crisis, the bundling together of mortgages and selling off tranches to various investors, mortgage-backed securities, things like this that have now become household names, amazingly enough. Toxic mortgage-backed securities. And an argument that we hear frequently is that, well, Fannie and Freddie, the GSEs, just followed Wall Street. Wall Street was making tons of profits. These were profitable products, and Fannie and Freddie rushed headlong in to grab market share from them, and that explains Fannie and Freddie's involvement. And so it was really Wall Street that was the prime mover behind this. But your investigation into this finds something very different.
Yes, this is what one would call an urban myth. It's been repeated so many times in the press that people have actually come to believe it, yet there isn't any data whatsoever to support this idea. Let me give you just a couple of numbers. The Wall Street activity, if you want to call it Wall Street activity, I might use the term Wall Street, but what that really means is that people who were selling these pools of loans were using the Wall Street investment banks and banks as underwriters for the pools. So in that sense they went through Wall Street, like every other debt security that is issued by any American corporation goes through Wall Street as underwriters, almost entirely. All right, so there was a lot of that happening. It was about a third of the 27 million loans that bad loans were outstanding. About 7.8 million, a little less than a third, went through that process. What caused that market to develop is the first question you have to ask. A market for subprime and other weak and risky loans had never existed before. Why did this one come into existence? Even though it was smaller than what Fannie and Freddie and the other government agencies were doing, why did it come into existence? And that became very clear, because over a period from about 1997 to 2007, a huge bubble developed, a huge housing bubble developed in the United States. Normally, bubbles extend for 3 or 4 years. After 3 or 4 years, delinquencies start to appear, investors leave, the bubble flattens out, and everyone runs for the doors, and those who don't get out soon enough suffer losses. This bubble lasted 10 years, something completely unprecedented. And why was that? It was because the U.S. government, between 1992, when these affordable housing requirements began, and 2007, was pouring money into the housing market and causing housing prices for that reason to rise. And as housing prices rise, they suppress delinquencies. It's obvious why that would happen. If your house is worth a lot more and you can't meet your obligations, you can easily refinance it, or you can sell it, or you can just hand it back to the bank that doesn't suffer any losses. Well, what does this mean? This means that investors are looking at a market in which the loans are high risk and pay more because they are high risk. People who get such loans have to pay higher interest rates. These loans were paying more, and yet they weren't suffering losses. So by about 2002, it began to occur, that was about 5 years after the beginning of this bubble, it began to occur to investors and people who wanted to sell these mortgages to investors that this was a pretty good deal. You were getting a pretty high yield on these mortgage-backed securities. That is, the principal and interest that was paid on them flows right through to the investors. That's how a mortgage-backed security works. You were getting a pretty good yield, and yet there were very few losses. So there was a discontinuity, if you will, between what the risks were and what the yield was. Made these things look very attractive. Okay, so there began to be a fairly significant market in mortgages. In 2002, in subprime mortgages, in 2002, the market passed $100 billion. It was $123 billion in 2002. In the same year, Fannie alone bought $206 billion in subprime loans. So, it's not really correct to say that Fannie followed Wall Street into the subprime business. Fannie was in the subprime business from 1992 right up until 2002, had been buying increasing amounts of subprime loans because, as I pointed out earlier, the affordable housing requirements kept going up, And they kept buying more and more subprime loans in order to meet those affordable housing requirements. So, in 2002, they were already heavily invested in subprime loans and in Alt-A loans. That's the reason why we have this alternative kind of market. It was built by government's investment in the housing field well beyond any investment it had ever made before, by trying to increase home ownership, providing more and more funds to people to buy homes, and that raised prices, suppressed delinquencies, and created that entire market that was so-called Wall Street's market. Eventually, of course, even that came to an end because housing prices rose so high by 2007 that no matter what kind of favorable concessionary loan you got, no down payment, no principal amortization, no documentation, whatever you got, you still couldn't afford a new house. The darn things were just too expensive. And so the bubble flattened out. People no longer could sell their homes if they couldn't meet their obligations. Those mortgages started to default. They started to default in enormous numbers. Investors saw these defaults occurring more than they ever expected or imagined. Investors ran from the private mortgage-backed securities market because they didn't know what was going on here. And when they ran, that crashed the market. All of the financial institutions that were holding these mortgage-backed securities couldn't sell them, had to write them down under principles of accounting called mark-to-market and fair value accounting and so forth, had to write them down. And as a result, they suffered losses of capital, and they looked weaker, and they looked as though they were in trouble. And so that's the whole mechanism by which we have this separate market. But Fannie and Freddie did not follow Wall Street into this market. Fannie and Freddie, along with the other government buyers, created the bubble that created the market in turn. And then Wall Street was able to start marketing these, that is, various organizations like Countrywide were able to sell their mortgages through Wall Street to investors around the world who were delighted to get mortgages that had such high yields with what looked like very few risks.
Another argument that is made by some of your critics, you mentioned the bubble. You finger U.S. government housing policy as leading to the bubble and leading to the weakening in mortgage standards. Right. And yet no one denies that there were bubbles that occurred in Europe, European countries in the housing sector. And so they say, well, Wallison's all wet because he says it's U.S. government policy, which doesn't have anything to do with why, Spain would have had a housing bubble or Ireland would have had a housing bubble. But you address that in the dissent. What's your response?
Well, it really isn't the bubble itself. It's the contents of the bubble that was important. In the UK, in Spain, in Ireland, in other European countries where there were, in fact, housing bubbles, after those bubbles deflated, the losses in the mortgage markets were very, very small. The UK was the largest, actually, and it had about 2.6% losses. Our losses were up, in some cases, as high as 25%. There's nothing even comparable when other bubbles declined compared to ours. And the reason was that we had all of these very weak subprime mortgages and other kinds of risky mortgages because our government was encouraging the creation of those. In Europe, the governments didn't create or work to create those things. The bubbles occurred. Bubbles always occur because people are very optimistic about once housing prices start to go up, people are optimistic. They think that there are reasons it will continue, and so they pile in and they create more housing increases and more bubbles and so forth, and then eventually the bubbles decline. But if you have a healthy bubble, that is one that is filled with mortgages that are prime mortgages, made to people who can actually afford the risks that they are taking when they buy a house, when that bubble deflates, you don't have the same kinds of problems. The reason they had serious problems in Europe after the deflation of our bubble was not because their bubbles deflated, it was because they had bought our mortgage-backed securities. Most people in the world thought, until this last crisis occurred, that one of the best investments you could get in the world was a U.S. mortgage, because Americans always paid their mortgages, and that was true until we had affordable housing requirements, which really subverted the American mortgage system, and most people in Europe did not even know that that had happened. In fact, most people, and this is amazing, most people in the United States didn't know either.
Well, most people here, that gets to my next question, because they didn't know, because as I was reading your dissent, I kept thinking, okay, well, this started in 1992 when the federal government started putting in these affordable housing requirements, and then there was a ratchet where it goes up and up over time. And again, it was a bipartisan thing. This happened with Democrats and Republicans, and everybody seemed to love this policy. But I kept thinking as I was reading it that how could this be the case with Fannie and Freddie, and but they not have to disclose the extent of their purchases of low-quality loans in their 10K. And then I read in your report, quote, the GSEs were exempted by law from having to file information with the SEC, unquote. Now, they voluntarily agreed to do that after 2002. Now, maybe people who follow this all the time knew that, but how is that possible? You can have these enormous publicly traded companies that didn't have to disclose a lot of this relevant information, and thus the pressures that may have come with market analysts saying, well, this can't go on. There's all this garbage in the system that's being put out because of government affordable housing requirements. That really didn't start to come out until the middle part of the 2000s or so.
Right.
Is that right? How is that possible?
Well, I imagine the shareholders of Fannie and Freddie are wondering that themselves. But it was a fairly remarkable and unique thing. When Fannie and Freddie were chartered, they were exempted from filing reports with the SEC. Moreover, the investor community and the analysts who serve the investor community didn't really care very much about what was going on in Fannie, because they assumed that Fannie and Freddie were backed by the U.S. government, and so why bother spending your time analyzing something that isn't a risk for most people, except the shareholders, of course. Now, for many, many years, Fannie and Freddie did very well for their shareholders. But in the 2000s, finally in 2002, they agreed voluntarily to file reports with the SEC. So you'd say, well, maybe at that time, analysts would get those reports and start to look at them and decide that, in fact, Fannie and Freddie were making subprime loans that nobody knew about. But that apparently didn't happen. Now, why it didn't happen is not entirely clear to me. I think there was a general sense in the market, not only that they were safe because they were backed by the government, but also that they always made prime loans. Why would they not make prime loans? I was, in fact, a critic of Fannie and Freddie. Starting in 1999, I began to hold conferences here at AEI and brought in a lot of people to talk about what was going on there, and almost everyone talked about the same thing, and that is that they were taking interest rate risk. They had these very large portfolios, about $1.5 trillion of mortgages that they were holding in 2005, 6, 7, 8, that period. And that represented a lot of interest rate risk, and people thought, gee, this could be a problem. No one said at any of these conferences, you know, they're taking credit risk. They are actually buying very weak mortgages. No one seemed to know it. Afterward, while doing this research, I went into their voluntarily filed 10Ks. And in the body of the 10K, I don't know whether you've ever had the displeasure of having to read one of those things. I wrote them, actually, when I was a lawyer. But in the body of the 10K, it said our exposure to subprime mortgages is very small, about 0.3%. Now, this was in a year in which, if you looked in the back of the 10K, they were saying that their holdings of mortgages made to people with less than a 660 FICO score were 16%. Now, 660 FICO score is about the dividing line between a prime borrower and a subprime borrower. So in the tables in the back of their 10K, they disclosed that they actually had 16% of these loans made to people who had blemished credit. What went on? How could they have done this? Was just simply a lie? The answer, I think, is not as clear as that, because there has never been an adjudicated answer to what is a subprime loan. And Fannie was taking the position, Freddie was taking the position, that a subprime loan is one that they buy from a subprime lender. Not the quality of the loan itself, but who they bought it from. Now, that seems a little transparent, seems a little manipulative. Maybe it's a fraud. I'm not making that charge, but I am saying that because of that strange thing where they were saying in the body of their 10Ks, to the extent that anyone read them, we have almost no exposure to subprime loans, 0.3%. Many analysts and investors and others may have just said, well, they're doing what they always did. They were always prime lenders, and only prime lenders. So we assume that all the loans that Fannie and Freddie are making are prime loans. So what it turns out is that in the U.S. financial markets, 12 million, which is the number of Fannie and Freddie loans by 2008, 12 million loans that were categorized as prime were actually subprime. And so when these loans started to fail, they started to fail in numbers that no one in the mortgage market, no investor in the mortgage market had ever seen before. How could this be? How could we have so many defaults going on in this market? And the answer was that they didn't understand the true constituents of the market. And
a lot of the models that were built by analysts to try to analyze what could happen under worst case scenarios were suspect, because everybody was operating under the assumption that, well, these are prime mortgage.
That's what I think.
Yeah.
That's what I think.
One other question that I want to get quickly to Dodd-Frank, and then we can wrap up. You mentioned earlier mark-to-market accounting, and that this is something about which you have strong feelings in the context of this discussion about the financial crisis, and yet it didn't get much attention from the majority in the commission. Talk about the importance of mark-to-market as after you have the run-up, you have this mechanism that gets all this garbage into the system that prompts a bubble that can ultimately pop. Well, we've had bubbles that have popped before in various sectors, but that didn't always have this kind of effect. What role did mark-to-market accounting play?
Well, first of all, mark-to-market is applicable to financial institutions, not to other kinds, not to oil companies or retailers or anyone else, just to financial institutions. And what it says is that you have to value your assets, your financial assets, based on what the market is willing to pay for them. If there's a market for them, that's the price you ought to put into your balance sheet to determine what your total assets are, and hence what your capital is worth. For a long time, people in the banking industry in particular have been worried about this, because it does introduce a tremendous amount of volatility. Prices go up and down in the securities market, and if you're holding securities and investors are no longer willing to buy those securities, they're worth a lot less. Well, what happened at the end of 2007 with all of these mortgage-backed securities out there was that investors left the market entirely, and it plummeted from a very high level of activity to almost nothing. And so all these financial institutions had to write down the value of the mortgage-backed securities that they were holding. Why that was not looked into by the Commission as a factor, The only answer I have is that they wanted to focus on lack of regulation and the lack of high quality risk management in the large companies and banks and so forth, and did not want to excuse either the regulators or the risk managers and the managers of these companies on the basis of the fact that there was this very peculiar accounting rule. I personally believe that the accounting rule was quite an important element here, because what it did was, if you think about investors, they've left the mortgage-backed securities market. They now have their money deposited in a bank, right? They're no longer buying mortgage-backed securities. They put their money in the bank. Now the bank is saying, because the bank holds some mortgage-backed securities too, the bank is saying, well, we've just written down our capital by a certain percentage because that's what the accounting rules require. And so people are saying, well, maybe the bank is now in trouble. And then you have Bear Stearns, Lehman Brothers, two very large investment banks, also seem to be in trouble. In fact, both of them in effect failed because they lost the confidence of the market, because investors were not confident that they really were solvent. And so if we look at the full context of this financial crisis, we'd have to say that a very substantial part of it was the worries that investors had about the solvency, stability of these financial institutions all over the world. And one of the reasons they had that was that they no longer understood the accounting. The accounting was telling them that these institutions were losing value very quickly. And so they started to pull their money out. That's what starts a panic. And that, I think, is a very important part of this crisis that was never looked into by the Commission. Now, I would have been willing, in every of these areas, to have changed my view if I had been shown any data which indicated that my view was wrong. Maybe only a very, very small amount of the losses in banks as a result of the requirement for a write-down to market price, maybe that was very, very small. Maybe someone can show me that the percentage was actually quite small and that the losses came from something else. But the Commission did so little investigation of that issue that we're still left in a position where we don't know.
Yeah, and it's not as if this was a minor issue. I mean, there were during 2010, there were, outside of the context of the Commission, there were plenty of people arguing about it. And there are plenty of people who defend mark-to-market accounting and can make good arguments for it. But those are arguments that should be aired and in the context of, it would seem to me, any commission that's looking into causes of the financial crisis.
Yes.
So, all right, final questions which have to do with Dodd-Frank. Now, obviously, the reform that emerged in the wake of the financial crisis left the barn before the commission that was tasked with looking into the crisis could report what it found. But I want to ask you two questions about Dodd-Frank. It doesn't do anything to address what you identify as the cause, which are the affordable housing requirements and the political manipulation of the mortgage market in the country to achieve social, basically what amounts to social policy. I want you to start with, of the things that Dodd-Frank does do, what are the most problematic? If it didn't even start with addressing what it, in your view, was supposed to, it does a whole lot.
Yeah.
And the SEC is still working on exactly what those rules are going to be. But of the things that it does do, what is really troubling to you?
Oh, just about everything. It's hard to identify anything in this 2,200-page piece of legislation that doesn't trouble me in one way or another. But I'll mention a few things that are really, really important and really, I think, you'd almost call them dangerous to the growth of our economy in the future. And maybe one of the reasons why we are still not able to climb out of the terrible recession we have had since 2008. Just a few things, though. First of all, we have the creation of something called the Consumer Financial Protection Bureau within the Federal Reserve. Now, this agency has a broader mandate than any other agency I can think of in the government. There isn't anything that comes close, because it is able to regulate how not only the largest banks and other financial institutions in the country deal with their consumers, their depositors, and the people who deal with them, but they also can regulate how the corner check cashing store in every little town in this country handles checks for its customers. In other words, anything that is financial, from the largest to the smallest, from one coast to another, including Hawaii and Alaska, is under the jurisdiction of this Consumer Financial Protection Bureau. Now, what can that possibly mean? That means that there will be a huge amount of additional regulation of all of these consumer-related matters. We know that regulation raises costs. We know that regulation stifles innovation. We know that regulation causes smaller companies to have to consolidate with larger companies because they can't afford the regulations that they have to address, work with. So it will have a major effect on our economy. But what are the countervailing forces? In our system of government, we have a Congress and a president and a system of courts. And the way they operate is that the president is generally in charge of appointing people and maintaining policies for the executive branch through the appointment power to people who are heading the major regulatory agencies. Congress does its control through the power of the purse, so to speak. Both of those are taken away in this legislation. The president can appoint the head of the Consumer Financial Protection Bureau, but for a single person for a 5-year period, and can only be removed for cause. So the president really has no power over what this person does after he or she is appointed. The Congress has no power either through the power of the purse, because the Consumer Financial Protection Bureau receives all its money from the operating funds of the Federal Reserve, which does not itself get appropriated funds. It earns its money through its monetary policy activities.
And does quite well.
It does very well. It usually gives a dividend to Congress each year, a dividend to the Treasury each year. But now a portion of that, about 12% of that, is taken away from the Fed and given to this Consumer Financial Protection Bureau, completely out of the control of any other part of our government. So not only do we have the problems that will be created by all of this new regulation, but there's no way for any of this to be controlled by any of the political branches. And the Fed itself is prevented by that statute from interfering at all with this bureau that is within it, institutionally within it, takes some of its money but is not to be controlled in any way by the Fed. That's one. And that worries me most from simply the constitutional elements of it. It seems all wrong in our system. It does not involve the kinds of checks and balances that we would want. The second thing that I think is a key here is that what the legislation does is set up a body within the Treasury Department, or under the direction of the Secretary of the Treasury, consisting of all of the regulators. And those regulators have the power to declare that certain financial institutions are systemically important. That is to say, if they fail, they will cause instability in our economy. What this means is that for the first time, very large financial institutions that have never been regulated before by the government, are now going to come under the control of the Federal Reserve, which once those designations have made, the Federal Reserve takes them over, in effect, and begins to regulate them. So, although in the past the Fed has regulated bank holding companies and banks, now it will regulate not only the largest bank holding companies and banks, but also all large securities firms, all insurance companies, all insurance holding companies, all finance companies, hedge funds, you name it. Any kind of financial institution will now be regulated by the Fed in several ways. One is their capital will be controlled, their liquidity will be controlled, their leverages will be controlled, and their activities will be controlled. What worries me most about this, there are two things really. One is there isn't any way that any regulatory agency can do this kind of job, because all of these institutions, the hedge funds and the banks and the insurance companies and all the rest, are all in competition with one another. And so you have a regulatory body that actually is in a position to give one group an advantage over another group. Let's say, for example, that the Fed says, well, insurance companies don't have to hold so much capital. That will improve their position vis-a-vis banks and maybe vis-a-vis hedge funds or finance companies. So that changes the competitive environment right there. That's one problem. A second problem is that what we are saying about these companies that are designated as systemically important is that they are too big to fail. That's what it means. If they fail, they will cause systemic problems, instability in our economy. We're designating them as too big to fail, all of these large companies. And what does that mean? That means that investors, creditors principally, will be much more likely to lend money to them at lower rates, because it's less likely that you will suffer a loss with these companies protected by the Fed and under the government's supervision than you will if you lend to some smaller company that doesn't have that kind of supervision. And what does that mean? That means that we'll have increasing consolidation in our financial system and a kind of partnership between the government and these very large financial institutions, because now the government has a real stake in their doing well and not failing, because if they fail, the Fed will be blamed for allowing these companies to fail, and on the other hand, they will be much more interested in currying favor with their new regulator, their new pal in Washington, rather than competing with one another. So we're going to have a much different economic system, financial system, as a result of that. Those are two things that really worry me. You think of anything else you want to hear about?
There'll be a few more, I'm sure. Okay. Final question for you. Given all the research that you've done on what has led to the financial crisis, if instead of a Dodd-Frank Act we had a Wallison-Pinto Act, what are the reforms that are needed that weren't enacted by the last Congress that would actually go a long way towards making sure we don't have this kind of financial crisis ever again?
Well, it's really pretty obvious now. If you read the Dissent, it's pretty clear what the problem is, and that is the government is mixing too much into the housing business. And in fact, here at the American Enterprise Institute, Ed Pinto and Alex Pollock and I have developed a white paper which has recently been circulating, and the argument we're making is the only housing finance market that is going to make sense for the taxpayers over the long run is to take the government out of the system of financing mortgages. No more government guarantees of mortgages, because whenever you have a government guarantee, everything goes in that direction. Everyone wants to be under that umbrella. And the government really is unable to price the risks that it is taking. The risks keep increasing because mortgages, for example, that are less and less prime, more and more subprime, will keep moving into the system because the buyers don't care. They're getting a government guarantee of some kind, so they don't care the quality of the mortgage. And the government will be taking all those risks. And sometime down the line, 10 years, 15 years, 20 years, there will be another catastrophe, just like Fannie and Freddie, just like the S&Ls, just like FHA. And the taxpayers will have to step up and pay many billions again. So the only real solution here is to take the government out of the housing business. And it's not hard. Actually, what we're recommending is that we kind of go back to a period in the past when we simply had almost only prime mortgages in our financial system. And if we can create a system in which only prime mortgages are made and securitized, then we can have a perfectly well-functioning, satisfactory mortgage finance system without the government's involvement. And that will save the taxpayers over the long run it will save them from huge losses. So that's the proposal we're advancing now. The administration's proposal is supposed to come out shortly, and we're hopeful that they'll agree with us. But if they don't agree with us, we will still have a very strong position to advocate before Congress, and that's what we'll be doing.
Okay, my guest is Peter Wallison here at the American Enterprise Institute. We've been discussing his dissent from the Financial Crisis Inquiry Commission's majority report, which you can find at aei.org/Wallison. Peter, thanks so much for taking time to talk to us today.
Thank you, Nick.